Hello, YouTube. Today we're going to be talking about how we had a messaging from Jerome Powell about there being more pain ahead. The market is not closing down that red today. We're only down by about 0.6 on SPY and 0.7 on QQQ, but there is a lot for us to go through today. As a quick preview, what I'm watching really closely is that S&P tagged the 50 DMA. Now we have a false breakout, which means that we actually broke out and we are failing to hold last week's high. If we look here to QQQ, we can also note that same thing happened, failed breakout. We're really close to support here on the 200 MA. And as we now look further down to some of these ETFs, including the Dow, which is still above. We look here at the IWM, it's below both. We look here to RSP, just above the 50 MA. We look here to New York Stock Exchange or 2000 stocks, just above that 50, but it has the same candle of a failed breakout. We also have XLK. Again, XLK has different weighting, notably less Amazon, less Tesla, which is why it is outperforming QQQ dramatically. Almost made it to the 50 MA, but has that same inverted hammer starting or a failed breakout. ARC, let's just skip it. XLV, still powering up, still looks bullish. And then we look at XLF falling back below the 50 MA, and we got XLE still above. So there's a lot for us to go through to unpack exactly what Jerome Powell had to say. We had the jobs report, CPI, Fed decision, the press conference, and now the question is, where do we go from here? If you wouldn't mind, please smashing that thumbs up as we're getting started. I would really appreciate it. Also want to leave you with a note that if you're interested in trading with me, Justin from YouTube, you can go to algo.com, where we currently have a 14-day free trial and a Santa special, which includes discounts up to 44% off from now until December 30th. All right. Second thing for us to look at here is going to be the daily chart, because now we have a few really interesting things. So we note that we closed right around yesterday's low. Yesterday's low, 399.07. Where did we close today? 399.4. But in post-market, we're over 400. There's a reason for that. It's OPEX coming up. So what is this? Well, it's a doji. It's a doji closing below the 200 MA, right around yesterday's low. Dojis mean indecision, roughly same size wick on the top and the bottom. There is bearish volume. And that same thing we pointed out yesterday, which means the E-mini futures and the 1-hour chart in regards to the biggest volume bar on the day, also red again today. So we got a red one today, red one yesterday. And that is the first time we have seen this going back to December 1st, which is when we actually had that bigger red day that led to the slide. So is this a start of more? Is there going to be less? Let's dig in. All right. Looking here to a few more things, just because SPY is actually technically below the 200 DMA. But as we noted yesterday, the E-mini futures is actually battling for it right now. We'll find out in about 50 minutes whether or not we're going to get the printed close above or below. And we're looking for 4036. If we can hold that area, we're going to get it. If we don't, we're going to close below it. So that'll turn into support or resistance going into tomorrow. What's also really interesting today is just that QQQ is pretty much tracking the S&P, but when we look to the dollar, down. We look to VIX, down. So like, what's going on here? S&P down, NASDAQ down, dollar down, VIX down, 2-year note down, 10-year note down, almost everything down. Bitcoin up. Interesting. Let's go through and try to understand what happened today now. And if you wouldn't mind, please smushing that thumbs up, please, and thank you. I would greatly appreciate it. So the takeaway that I heard from Powell is that there is more pain to come, meaning we need to see unemployment go higher, or for roughly 1.4, 1.5 million Americans to lose their job here. And that's because we need slack in the labor market for that wage price spiral to potentially not materialize. I think everything I heard is hawkish. However, is Jerome Powell job boning to try to make the market go down? Because he actually did step down the rate of increases. But there's a difference between a hawkish. So let's go back to SPY. So he delivered a lower rate of increases, going from 75 to 50. But this was a hawkish 50, which means even though we are now raising by less, he's telling us that financial conditions should not be loosening. We need them to tighten. That's what I heard. Reading these headlines as well, this is the story that I heard today. No one knows if we are going to have a recession or not. He's not going to tell you we're going to go into a recession. The Fed is never going to forecast a recession. So this is as close as we're going to get to him saying it. No rate cuts until confident inflation moving towards 2. And that 2% is really important because right now we're still at 7. So he was asked about the inflation report last week, and he said, it is not really good enough. We need to see it higher. So if we need to see it higher, and as of right now, we're not sure if we're going to get there, 2% is like a really important number to keep in mind. Size of February rate hike will depend on incoming data. So he's no longer providing future guidance. U.S. rate futures now expect 70% chance of 75 basis point hike at the next meeting. Not 50, a 70% chance of a 75 basis point hike. Fed's Powell, strong view on FOMC is we need to hold rates at peak until we are really confident inflation is coming down in a sustainable way. No rate cuts until confident inflation's moving. Confident. We need to be really confident. What does that mean? We need to see a trend of not just lower inflation. We need to see it actually going negative. I don't have the number up, but last week it was 7.1 when we got that print. And we were at like 0.2 or whatever on the month over month. We need to start seeing contractions, which means negative inflation. Otherwise, we're still at about 7, which is too high. So pretty much came in line here. FOMC decision coming in at 4.5. We can note that the net effect is that most stocks are down. Pfizer's up just because they had some news specific to the company. But otherwise, it's not deep red. Tesla's still the Lone Ranger in terms of being deep red. Otherwise, we wouldn't even really know there was a Fed day today looking at this. You'd be like, marginal red across the board. Everything took a little bit of a haircut. If we zoom out, though, what's the trend? It's still mostly green. So we gave back some of the gains. How about 1 month? Mixed. This is where the story of rotation is playing into the end of the year, tax loss harvesting, and all that good jazz. All right. We forgot its OPEX as well. That is right. So I'm not going to look at today's chain. I'm going to focus on the one for December 16th, which is going to be the monthly expiry for December. And what I'm just noticing here is that 400 appears to be like max pain. So where do we close in after hours? Where do we close today? Well, 399.4. So 399.4. And then where are we now? Well, 400.3. So a little bit below 400, a little bit back above, but we're basically throttling 400. No surprise. That's where max pain is. I'd also note there's more calls to burn than puts. So for max pain, as of right now, in my opinion, I think 400 or lower is where the market makers want it. Are they going to get what they want? Who knows? They usually win. Usually does not mean always. So holding it here is going to be important. And that is going to also be important for the sentiment into the chart going into the rest of the week. Why? Well, as of right now, we have a shooting star, but we're green on the week. And is this just all OPEX related? I don't know. The move on CPI has historically been bigger than the move on the Fed, and today was no exception. So we likely have the range for the week, and now it's a matter of where we close. 400, 401, 399, take your pick. Make sure to drop me a comment and tell me what you think as well. And here we go. Let's move forward. So what really happened today? Here's what changed in the new Fed statement. They crossed out 2 words and put in 2 new ones. So creating additional to contributing to upward pressure on inflation, blah, blah, blah. And then they went, the committee decided to raise the target range from 3 to 3, blah, 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 to 4.5. So there's nothing really different here. Nothing else is crossed out, which means status quo. If you remember what Jerome said at the last meeting, he wanted financial conditions to tighten. That's what he wanted. We're now at the highest level in 15 years too. So it's really interesting. When we look here to the SEP, or the Summary of Economic Projections for December 14th, here is the part we talked about. I think it was maybe last weekend or the weekend before. I'm going to focus on a couple numbers here. So I'm going to do a little bit of drawing so you can understand. And at the onset here, understand this stuff is complicated. So if you get confused, just hang tight with me for about a minute and I will explain to you what I am seeing. There's a few things we want to look at here. Notably, we want to look at 2022 to 2024 and a little bit beyond. 2025. So these numbers here. The number below on every line here is going to show where we were at in September. And the new one's going to show what they are now currently projecting for December. So let's go through these one by one. So in September, they were projecting slower growth into this year, higher into next year, higher into 2024. These are now being revised down for 2023 and 2024, stabilizing in the long term. The Fed thinks the economy is going to soften by a notable amount here for next year to 0.5 from 1.2. This is also pretty much the consensus right now. So it's pretty much in line with where economists, basically people who are paid to do this, right now the US is expected here to go in at 0.4. So the Fed saying 0.5 is now a lot closer to the consensus of everyone out there on Wall Street. When we look here to the next one, unemployment rate is actually going to tick down this year because it's now backwards looking. We're already into December, but going out to 2023 and 2024, unemployment rate is going to go higher to 4.6. And it's going to stay there. It's going to be sticky. In the long term, it's going to stay here at 4.5 into 2025. That's a long time. That's people losing jobs. That's the more pain that I am talking about. We look here to inflation. The Fed's gauge is PCE, notably core PCE. They see it going higher now, higher next year, higher 2024, higher 2025. Oh man, that's like really important. Yes, sir. Really important. Oh, sorry, that's PCE. Core PCE. Next one here. Higher, 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 flat. So this is like important to track. Lastly, we got the Fed funds futures. Flat for this year. Next year going higher. 2024 going higher. And 2025 going higher. Notably, this number right here at 5.1. There are 17 out of the 19 FOMC committee members, or a consensus that we now need to be above 5%. That is really important to me. I'm now going to tell you what I am thinking here. Not that I know, but what I am thinking. I'll tell you really fast here. So the Fed is now much closer to what everyone else is already expecting at 0.4. But we also have to keep in mind, when's the next time they're going to meet? We were told 70% chance of a higher rate, meaning 75 going into February 1st or 2023. And the next time we're going to get that SEP, or Summary of Economic Projections, is going to be in March. So here's what I think is happening. I'll make it really simple because I think it's simple. And then we'll look at the charts to see if we're getting the confirmation. So right now, they're saying that growth is going to slow. Every time they meet, they go a little bit lower, lower, low, lower, low, lower, low. If they just went and said, all right, we're here right now, and boom, it's going to be all the way down there, the market would overreact. Jerome is not trying to kill the market, not trying to squash it. He's trying to tame it. So that's what's important. Low, lower, low, lower, low. At the next meeting, if they keep revising lower, that's him basically saying, wink, wink, nudge, nudge, we're going into a recession. He's not said that. He will not say it. That's not his job. He's never going to do it. On the meantime, though, they're also saying unemployment rate and inflation are going up, up, up. Instead of just going from here to infinity, like to a very high number, he's progressively making it higher. So the market is able to digest the move. If you would have told me this time last year, the Fed fund rate would be pretty close to 5% going into the end of the year, I would have said SPY 300, SPX 3000. Well, we're a lot closer to 400 right now, or 4,000. Why? Because of the gradual messaging. Messaging is a very powerful tool right now. So if we think about when is the Fed actually going to pause, because Jerome had a chance today when he was asked about when are you going to downshift to 25 basis points, he pretty much said we're data dependent. So the market was trying to do, and the reason why it was so choppy is because if we go from 75 to 50 to 25, it means zero is pretty close. Zero is when we get the pause. The market was trying to price it in. He punted, which means he decided not to answer the question and to say we're data dependent. That's like a really big deal. So that's the reason why I think we had a little bit of turmoil up and down all around. I think that when they stop raising rates, it's going to either be in March or in June, because as I just mentioned, right now, the Fed is still gradually saying growth is going to lower, lower, lower. Inflation is going to go higher, higher, higher. But now we're getting incremental higher highs. Until the Fed is no longer adjusting their SEP on GDP, on inflation, on employment, and also on the Fed funds rate, I think they are behind. They were behind on hiking. They're currently behind on when they're going to have to actually tame this inflation. So what I want to see is probably what happens at the next meeting, but notably what happens here in March. The Fed funds futures right now is pricing in a terminal rate between May and June. So it aligns with my current thinking. Do I know everything? Of course not. I do not know everything. That's just how I'm reading it for today. And what we now want to look at is how did the market actually react with all this data? So let's go back here to our two boards. Let's look here at two charts because I think these are the important ones. So this is the E-mini futures. And what I want to do here is actually delete all my lines for a moment. And then I'll, So let's not do that. Let's go here. Let's actually delete the, let me actually just double check and make sure I didn't delete anything I didn't want to. 1 second here. Sorry. I don't think I did. Perfect. I deleted all my indicators. Bring them back. There we go. Okay. So if we go here, we delete the drawings. Here's what I'm noticing. So we talked about the exhaustion move. Well, it's looking more like we are exhausting. Why? Powell pump. We retrace the first candle, the second candle, full retrace, and then a lower low. Okay, cool. And then what happens? Well, we carve out a bottom and move higher. So what happened here? Well, there's the CPI print, right? There's the pump, there's the full retrace in the lower low, and there's the lower low. We are not able to crack higher quite yet. It is very obvious to me. What we saw was a knee-jerk reaction lower, an attempt to dead cat bounce, but then a failure. Why? Well, we got a double inside bar. So the dominant move was this one here. We did not get the knee-jerk reaction, right? We're lower. That's the story. Same thing as over here, where knee-jerk reaction, ultimately retrace it. This is bearish and bearish because we got inside bars. That's what I'm noticing. Really curious about this, though, is when we look here to pre-FOMC decision to where we are now, there's the high, and then we got a lower high here. Now let's look at the dollar. Why? Because the dollar actually managed to print a lower low, rejecting off a weekly level at 103.8. Why does that matter? Well, the dollar went, right, it went up, and then down, and then more down. So if the dollar printed a lower low, it means S&P could have printed a higher high. It did not, which means the market is moving more on its own. This rejection right here was really notable to me. It's the rejection of the previous base, the previous VWAP, and this previous low. That's what it means to me. It means we failed to be more bullish post-meeting. Is that OPEX related? All about 400 SPY? I think a lot of it is related to that, but I don't know if we can say all of it is related to that. So that 400 on SPY is the max pain. If we're going to get that overshoot higher, we're probably going to see that into next week. I don't think we're going to get into Friday. We got the ECB decision tomorrow, so the dollar's likely going to chop up more. But as of right now, that is the dominant story for me. I also want to point out two things here. So now let's delete everything again. We're going to go from low time frame to high time frame. And we talked about the 50 and 200 MA yesterday. So let's do it again here. 50, 200. We're stuck on the hourly. So on the 1 hour chart, we are stuck between the averages. What is that? It's a kangaroo. Not bull, not bear, kangaroo. Let's look at the daily. Here's where we got to see that printed close to confirm it. ES is over. S&P is not. S&P is below. So here, we're actually bullish because we're above both averages. Is it going to hold? We'll find out in 34, 35 minutes when this futures market closes out at 5 p.m. Look at the 1 week. Below both. So that's the kangaroo. Okay, now let's look at the 1 month. Above both. Okay, so very long term or 1 month, we're trending up. On the weekly, we're in the kangaroo, but we're closer to resistance, meaning the 50 MA. We're closer to the average than we are to support. Support's down here at 36.55. Look in the daily. Well, if we don't hold here, we're like pretty close to resistance. That support's like pretty far away. It is. It's pretty far away. And when we looked at this yesterday, the humble line chart gives us a pretty clear story. Let's look at SPY and remove that VWAP just to make sure the story's clear here. All right. Head and shoulders, knees and toes, knees and toes, knees and toes. So shoulder, head, shoulder. It's very obvious. And rejected off the 200, just like we talked about yesterday. So is this enough? Can we say it's said and done? I don't think so. I think we got to see where this weekly candle closes out. I think we have to see next week's candle close out too. Post FOMC, post ECB, post OPEX, and all of that good stuff. But as of right now, I do have a bearish tilt. Am I positioning mega bigly right after the tits short? Also, no. Let me go back here to my final chart. And the reason why is because I think we have to give it a little bit more time. So I'm already positioned. What I saw today does not make me want to change my mind. We have a spinning top, right, or a doji. I don't know. Like we're right around yesterday's low. So if we defer to here, we look at the weekly chart. Here's what I'm noticing. We poke the 50. We have a falling breakout. Failed breakout, which means we poked over the previous monthly high, and now we fell below it. So if we close below 405, that's a big, big warning. And now on the daily chart, what do we have? Well, if there's a failed breakout on the weekly, we have a high and a low, and we got a lower high and a lower low. So this inside bar broke bearish. It tried to hold on for a large part of the day, and then it just didn't. So right now, I am noticing the signs of exhaustion, but it might get deferred until next week. Might get deferred until the end of the year. Why? Bonuses, baby. Wall Street banks are going to be cutting salaries, cutting bonuses. So what do they need to do? They need to beat the market. They need to outperform to get those bonuses. Even if it's artificial, that's called window dressing, by the way. And we'll see what happens. With that said, I think that now we have some clues for short-term direction. Fundamentally, I think that we are hawkish or bearish in the medium to longer term. I am less confident in the short term. So with that said, I think we've given you a great update. And as we go into Friday and to the end of next week, I think we will get additional evidence to support the bear or bull thesis. We wish you guys all good luck. If you would like to smash a thumbs up, that'd be greatly appreciated. And if you're interested in seeing how we traded today as a community, exactly what I did, you can join us for a 14-day free trial by clicking on the link in the description and getting up to 44% off and joining us for that Santa special. Thank you so much for watching, and I look forward to seeing you tomorrow. Thank you.